Well, it's official. 8% mortgage rates are here. And on top of that, the likelihood of another Fed rate hike just increased today, which is Tuesday, October 17th. In today's video, I'll explain why did rates increase so much today, how it's impacting our US housing market, and of course, home buyers as well. I have a lot to share in today's video. And before we get started, if you guys are new here, I invite you to subscribe to this channel right now because I post frequent housing market updates so you guys can make a more informed decision about whether to buy or sell a house right now based on the latest data we have. So I have a lot to share in today's video. Let's go ahead and dive right in. So just doing a quick Google search of mortgage rates today. The average rate today, which again is Tuesday, October 17th, according to Google here, 8.32%. Absolutely crazy. So for someone buying a $300,000 house, over 8.3%. Also, according to Investopedia.com, as of today, the average rate is at 8.20%. Again, this is all for people with exceptional credit buying their primary residence and putting down at least 20% to buy a house or have at least 20% equity in their houses if they want to refinance. Also, according to the Mortgage News Daily, as of today, the average 30-year fix is at 7.92%, blowing the previous high we had going back to the year of 2000 that we saw about 2 weeks ago when average rates were at 7.81%. Now it's at 7.92%. A jumbo is at 8%. FHA and VA loans are around 7.35%. This, by the way, at 7.92%, the highest rates we've had going back to September of 2000. And that is right there. According to Freddie Mac, the highest rates we've had going back to September 8th, 2000, when at that time, the average rate was at 7.94%. So in today's video, again, I'll explain how this is impacting current home buyers and why rates increase so much. Let's first talk about the increase in prices and rates compared to 4 years ago. Back in August of 2019 compared to more or less prices we're seeing today, and of course rates today. So this is a really good, not a sponsored video by any means, but this is a really good calculator that I use on the Mortgage News Daily's website here. So back in August of 2019, the average or the median sold price, I should say, according to the National Association of Realtors or NAR, was $278,800. So assuming someone buying a house, an average price home back in August of 2019, putting 20% down, your average rate back then was around 3.6%. So in looking at your principal and interest payment or P&I payment, that would only be $1,014 per month to buy a median price home back in August of 2019. Look at this though, this is just absolutely crazy. The median sold price as of August 2023, this year, is around $407,000. Again, putting 20% down, looking at your daily rate at 7.92%, your new housing payment would be a whopping $2,372 per month. That's a whopping $1,358 more per month to buy a median price home today compared to 4 years ago. I have been calling the rise in prices and rates kind of like this quadruple whammy that home buyers are facing right now. So number one, the median sold price over the past 4 years has increased $128,000 or an increase of 46%, going from $279,000 to approximately $407,000. That's number one. Number two, rates have more than doubled over the past 4 years. To be exact, an increase of 4.3 percentage points over the past 4 years, and that caused a 43% decrease in buyers' purchasing power. So your purchasing power over the past 4 years here has gone down by 43%, yet home prices have surged by 46%. That's number two. Number three, again, your average monthly housing payment to buy a median price home today compared to 4 years ago just surged by nearly $1,400 more per month. That's a giant increase of a 134% since August of 2019. And number 4, because rates and prices have increased so much over the past several years here, you're going to pay approximately $386,000 more in interest paid over that life of that 30-year fixed rate loan. Let me share an example with you guys using this example here. So when rates were at 3.6%, the median sold price was at $279,000. You're only going to pay $142,015 in interest paid over the life of that 30-year fixed rate loan. Look at this giant decrease or giant change here, because when rates surge to 7.92%, of course, because prices increase as well, you're going to pay $528,091 in interest paid over the life of that loan. And that's $386,000 more in interest paid because prices, and more importantly, because rates increase by more than 4 percentage points. Additionally, this $528,000 in interest paid is much higher than your original purchase price of only $407,000. In my personal opinion, this is not sustainable to see your average monthly housing payment increase by 134% over the past 4 years, and not to see wage gains not even come close to that. So wage gains over the past 3 years, going back to 2019 through 2022, have only increased by 8%. The median family income nationwide back in 2019 was just over $86,000. In 2022, it only increased to $92,750, a small increase of 8% compared to the over 100% increase in your average monthly housing payment. This, of course, has huge implications for homebuyers right now, but also our housing market in general, especially if we have these high rates sustain in the long term here, because this really should impact home buyers right now. So we could see a huge pullback in contracts being signed between buyers and sellers, but also because a lot of people are getting priced out as well because of this lack of housing affordability right now. Sad but true. So what happened today? Again, this is Tuesday, October 17th. Look at this. The 10-year treasury, the yield on that increased to 4.845% as of about 2:40 p.m. Eastern Standard Time, a giant increase of about 14 basis points compared to yesterday. And this, by the way, about 4.85%, the highest yield on the 10-year going back to 2007. I mention this because the yield on the 10-year is loosely tied to the rate for mortgage rates. And of course, this is one reason why rates increased so much today. So why did rates increase so much today? Which, by the way, I want to share this with you really quickly here. So according to the Mortgage News Daily, rates increased 12 basis points today. And then on Monday, they increased by 14 basis points. So in the span of just 2 days, average rates increased by 26 basis points or 0.26 percentage points. So going back to why rates increased so much, that's because retail sales for the month of September surged well below expectations here. So according to CNBC here, it says consumers showed surprising strength in September, boosting retail sales well above expectations despite higher rates. Retail sales nationwide increased by 0.7% on the month for September, well below the estimate of a gain of 0.3%. This is according to the Commerce Department that was released today. Excluding autos, sales were up by 0.6%, well ahead of the forecast of a gain of 0.2%. So the Fed is not going to like this whatsoever because they don't want to see people continue to spend their money, which of course increases inflation. They want to see the labor market slow down. They also want to see people not spend money because when you spend money, that causes inflation. So the Fed is not going to like this. And because of this, the likelihood of another rate hike by the Fed just increased. So the next meeting by the Fed, which is the FOMC meetings, is in 14 days from today. And this, by the way, is a CME Fed Watch tool, which provides the likelihood of future rate hikes and changes by the Fed. So the next meeting is scheduled for November 1st. There's a 91.2% probability that the Fed will pause any rate hikes in their next meeting, and only an 8.8% chance that the Fed will increase rates by 25 basis points, going from 5.5 to 5.75%. Look at this though. So December 13th, their next meeting or the last meeting this year, the likelihood of a pause again is at 57.2%, whereas the likelihood of a rate hike of 25 basis points up to 5.75% just increased to 38.6%. So the majority is saying here we're not going to see a rate hike, but look at this big change here. So the probability again at 38.6% of a 25 basis point rate hike is at 39%. Look at this though. 1 week ago, the likelihood was 25%. Also yesterday, the likelihood was at 32.7%. So even though the street is forecasting for the Fed to pause any rate hikes for the remainder of the year, the likelihood of another rate hike actually just increased, especially for December. In addition, the street is forecasting that the Fed is going to keep rates at a high level for longer than was previously expected here, because the Fed or the street is not expecting for a Fed pivot or for the Fed to decrease rates anytime soon. In fact, you have to go all the way until July 31st of 2024 to see a stronger case of a Fed pivot here. Let's look June first. So June 12th, there was a 37.1% probability. We're still going to be at 5.5%, which is the rate we have today. Then only a 30.1% probability of a 25 basis point decrease to 5.25%. Their next meeting, July 31st, a 33.5% chance the Fed is going to decrease rates to 5.25%. So in other words, the likelihood the Fed will keep rates at the current range right now at 5.5% is very strong, especially because the street is not expecting a Fed pivot anytime soon. And this, of course, affects mortgage rates as well, because the chances of rates decreasing significantly anytime soon is also very unlikely as well. But that's my biggest takeaway from today's video. What's your biggest takeaway? And what do you guys think about rates over the next 12 months here? Please leave me a comment below. I appreciate you guys watching today's video. Like and subscribe, and I'll see you on the next video.